Ready to explore the fascinating world of finance? We're diving deep into Frederic Mishkin's The Economics of Money, Banking, and Financial Markets. And I have to say, I'm a little intimidated.
Well, think of it like this. We're taking a financial x-ray, peeling back the layers to see how this complex machine really operates.
Okay, that helps. So let's start with something that's always puzzled me. Interest rates. What are they really all about?
Essentially, interest rates are the cost of borrowing, like the price tag attached to using someone else's cash.
Right, so it's like a rental fee for money. But Mishkin talked about this thing called yield to maturity.
Ah, yes. Yield to maturity provides a more complete picture. It takes into account not just those periodic interest payments, but also any potential gains or losses if you hold onto a bond until it matures.
So it's looking at the entire investment journey, not just a snapshot in time. Now, Mishkin drops this crazy stat. Back in the early 1980s, interest rates on Treasury bills went above 16%. Can you imagine?
It's hard to fathom the impact that must have had on borrowers. I mean, mortgages, business loans, the entire economy felt it.
It really highlights how sensitive the financial system is to these fluctuations. It
Mhm.
makes you wonder how we even function without banks or financial markets.
Mhm.
I mean, where would businesses get the funds they need to operate? How would we save for retirement?
It's hard to overstate the importance of a robust financial system. It serves as this crucial link between those who have excess funds, the savers, and those who need capital, the borrowers.
So it's all about connecting the dots between those two groups. And Mishkin outlines two main paths for this matchmaking: direct finance and indirect finance.
Exactly. Direct finance is when, let's say, a company issues stocks or bonds directly to the public, cutting out the middleman. Indirect finance, on the other hand, involves intermediaries like banks.
So with direct finance, companies go straight to the source, like with those big IPOs we hear about. But here's the thing that blows my mind. Mishkin says less than 10% of external funding for American businesses comes directly from households.
That's right. Financial intermediaries like banks, insurance companies, and mutual funds, they really dominate the scene.
So if companies can go straight to the public, why rely so heavily on these intermediaries?
It comes down to a few key factors. Intermediaries are better equipped to minimize risk, they provide liquidity, and perhaps most importantly, they help navigate the treacherous waters of asymmetric information.
Okay, asymmetric information. That sounds ominous. Break it down for me. What is it and why does it matter?
Well, think of it like this. You're buying a used car, and the seller conveniently forgets to tell you about that persistent engine problem.
Oh, that's not good.
Exactly. That's adverse selection when one party in a transaction conceals crucial information. Now apply that to the world of lending. A lender can't fully know if a borrower will use the money responsibly or even pay it back.
I see. So it's like a game of financial hide and seek where one side has a distinct advantage. And that's
Mhm.
where moral hazard comes in, right?
Right. Moral hazard is the risk that someone might take excessive risks after getting a loan, knowing that others will bear the consequences if things go south. So, how do financial institutions protect themselves from these sneaky problems?
That's what I want to know. They're dealing with people who might be hiding information or planning to act recklessly.
Mishkin outlines a few strategies. They screen borrowers carefully, monitor loans closely, and they might require collateral or impose restrictive covenants to minimize potential losses. But even with all those precautions, things can still go wrong.
Which brings us to those dreaded financial crises, those economic earthquakes that shake the foundations of the global financial system. What triggers these events?
Financial crises erupt when the smooth flow of funds within the system is disrupted. Often this happens because those problems we talked about, adverse selection and moral hazard, suddenly get much worse.
So it's like a financial traffic jam, everything grinds to a halt.
Exactly. And this can cripple businesses, decimate household finances, and trigger a full-blown economic downturn. Now, there's a whole bunch of things that can spark these crises. Mishkin points to sharp increases in interest rates, surges in uncertainty that make people hoard cash, and asset market crashes that wipe out wealth.
He also mentions troubles within the banking sector that clog those lending pipelines. And even government fiscal imbalances can contribute to instability.
He uses real-world examples to drive this point home. He dissects the Mexican crisis of 1994-95, the East Asian crisis of 1997-98, and the Argentine crisis of 2001-02.
All of these crises involved currency devaluations, speculative attacks, economies on the brink of collapse. It's terrifying to think about.
And the truly scary part is the cascading effect. Lending dries up, the economy contracts, which further weakens firms and households, and boom, you've got a full-blown banking crisis.
So in this volatile financial landscape, how can we as individuals protect ourselves? I mean, stuffing cash under our mattress doesn't seem like a viable long-term strategy.
It's not about hoarding cash, it's about understanding the inherent risks involved. Diversify your investments, be cautious about who you lend to, and do your due diligence before engaging in any financial transactions.
Sounds like solid advice. Now, we can't wrap up this first part without at least touching on those mysterious derivatives. I'll admit they've always been a bit intimidating.
Derivatives can seem like the shadowy corner of finance, but they're actually more straightforward than you might think. Essentially, they're financial contracts whose value is derived from an underlying asset.
So like a side bet on the future price of oil or the movement of interest rates.
Precisely. Mishkin breaks them down into a few main types: forward contracts, financial futures, options, and swaps. Each has its own quirks and purposes, but they're all about managing risk.
So they can act as a shield against financial storms, but also a potential source of significant losses if things go wrong.
Exactly. Mishkin highlights how financial institutions use derivatives to manage interest rate risk, but he also cautions against their potential pitfalls if not used carefully.
Well, I'm already feeling like I need a financial dictionary to keep up with all this jargon. But before we move on, can we crystallize some of the key takeaways from this initial foray into the world of finance?
Absolutely. First and foremost, interest rates, while seemingly fickle, actually reflect the cost of borrowing and have a ripple effect throughout the entire economy.
We also learned about the vital role of the financial system in channeling funds from savers to borrowers, with intermediaries like banks acting as the matchmakers.
And let's not forget about the ever-present challenge of asymmetric information, those hidden secrets and potential risks that financial institutions need to constantly combat.
We also got a glimpse into the triggers and consequences of financial crises, those economic earthquakes that can devastate the global financial system. And finally, we dipped our toes into the world of derivatives, those mysterious instruments that can both mitigate and amplify financial risk.
So much to unpack, and this is really just the beginning.
Stay with us for part 2 as we delve even deeper into the fascinating realm of finance with Frederic Mishkin as our guide.
Okay, so let's shift gears a bit and talk about money itself. You know, the lifeblood of the financial system. Mishkin reminds us that to make all these financial transactions happen smoothly, we need a common medium of exchange.
Something we all agree has value, so we don't have to barter chickens for haircuts, right?
Exactly. But the story of how we got to our modern monetary systems is actually quite fascinating. Early civilizations relied on tangible commodities like gold and silver.
Well, that makes sense. Those things are scarce and have inherent value.
Right, they provided a tangible measure of wealth. But carrying around sacks of gold isn't exactly convenient.
No, I can imagine that got old pretty quickly.
And that's where paper money came in, revolutionizing the portability of wealth. But of course, every solution creates new challenges. Counterfeiting, for example, became a major concern.
Trying to maintain the integrity of paper money must have been a constant battle.
It was. But then came another pivotal shift, the introduction of checks.
Ah, checks. Such a simple idea, but it must have felt revolutionary at the time.
Imagine not having to physically transport large sums of cash for every transaction. Checks brought a whole new level of convenience and security to the financial world.
And paved the way for the electronic transactions that dominate our lives today.
Absolutely. We're rapidly moving towards a largely digital system with online banking, mobile payments, and even cryptocurrencies gaining momentum. But Mishkin cautions us against assuming it'll be a smooth transition to a completely checkless society.
Why is that? What are the roadblocks?
Well, there are serious concerns about security and privacy, and ensuring that everyone has access to the necessary technology is a huge hurdle.
So a fully digital system might be the ultimate goal, but getting there won't be easy. Now, Michigan spent a lot of time talking about government regulation in the financial realm. Why is that? Shouldn't the free market be able to regulate itself?
While free markets are great in many ways, financial markets are particularly vulnerable to those information asymmetries we discussed earlier, where one party has more information than the other.
Right, the used car salesman with the hidden engine problem.
Exactly. This asymmetry creates fertile ground for fraud, instability, and systemic risks that can have disastrous consequences.
So regulations aren't about stifling innovation. They're about setting some ground rules to make sure things stay fair and stable.
Exactly. Requiring companies to publicly disclose their financial information levels the playing field for investors. Restrictions on what kinds of financial institutions can exist and what assets they can hold help curb reckless risk-taking.
And things like deposit insurance, reserve requirements, and caps on interest rates, those all contribute to protecting depositors and fostering a more stable financial environment.
It's all about finding that balance between allowing the markets to operate efficiently and preventing a catastrophic meltdown.
Speaking of balance, Mishkin delves into the U.S. banking system, exploring its unique structure and competitive landscape. Why is understanding this framework so crucial for grasping the bigger picture?
The banking industry is the backbone of the financial system. It channels funds, provides liquidity, and facilitates all those payments that underpin economic activity.
So it's like the circulatory system of the economy, keeping things flowing.
Precisely. And understanding its structure helps us identify its strengths, weaknesses, and how susceptible it is to those financial crises we talked about.
Mishkin points out some interesting quirks about the U.S. banking system, right?
Now, historically, the U.S. had a ton of banks compared to other developed nations, partly due to regulations that limited interstate branching.
Interesting. So lots of smaller, localized banks instead of a few national giants?
Yes. This fragmentation fostered competition, but it also made the system a bit inefficient and vulnerable to regional economic downturns.
But that landscape is changing, isn't it?
Oh, absolutely. Deregulation, coupled with rapid technological advancements, has led to a wave of consolidation in the banking industry.
So we're seeing bigger banks, fewer players, and this blurring of lines between traditional banking and other financial services.
Exactly. And this raises concerns about those too big to fail institutions where the collapse of one giant bank could bring down the entire system.
That's a sobering thought.
It is. Policymakers are constantly wrestling with how to encourage competition while also safeguarding systemic stability.
And speaking of systemic stability, Mishkin doesn't shy away from analyzing those dark chapters in financial history when things went haywire.
Unfortunately, financial crises are a recurring theme. He takes a deep dive into the savings and loan crisis of the 1980s, a cautionary tale of deregulation gone awry.
It's a reminder that even well-intentioned policies can backfire. What lessons can we learn from this particular episode?
The S&L crisis stemmed from a perfect storm of relaxed lending standards, risky investments, and rampant fraud that overwhelmed regulators.
And in the end, taxpayers were left footing the bill for the bailout, highlighting the close connection between financial stability and shared responsibility.
It's a powerful lesson. Mishkin then shifts his focus to financial innovation, arguing that while it has the potential to bring tremendous benefits, it can also magnify systemic risks.
So it's a double-edged sword. New financial products and services can streamline processes and expand access to credit, but they can also create new avenues for speculation and excessive leverage.
And those interconnected risks can quickly cascade through the entire system.
The 2008 subprime mortgage crisis is a prime example of this, right? Those complex mortgage-backed securities, initially seen as a way to spread risk, ended up fueling a financial meltdown.
Precisely. Mishkin's analysis underscores the importance of having a robust regulatory framework that can adapt to the ever-changing landscape of financial innovation.
So it's not about stifling progress. It's about putting safeguards in place to mitigate the risks that inevitably accompany innovation. Now, while we've been focusing mainly on the U.S. financial system, Michigan acknowledges the growing globalization of finance. What happens in one part of the world can ripple through markets across the globe.
We're all operating within this incredibly interconnected financial ecosystem.
And this interconnectedness has huge implications for policymakers, investors, and anyone trying to understand how the global economy works.
Think about currency exchange rates, for example, something Mishkin explores in depth. Fluctuations in the value of the dollar impact not only American consumers and businesses, but also trading partners around the world.
It really highlights the global reach of financial decisions and policies.
And it makes international cooperation absolutely essential for addressing those global financial challenges, preventing those contagious crises from wreaking havoc across borders.
He discusses the role of institutions like the International Monetary Fund, the World Bank, and central banks, those guardians of global financial stability.
It's a complex and constantly evolving landscape, but understanding the basic principles of finance, the interconnectedness of markets, and the role of domestic and international regulation is essential for anyone navigating this world.
We've covered a lot of ground in this deep dive, from interest rates and banking regulations to financial crises and the globalization of finance.
It's been a fascinating journey exploring the intricacies of the financial world and how we're all connected to this web of opportunities and challenges.
Before we wrap up this part, let's revisit one of Mishkin's central themes, the crucial role of financial intermediaries.
Those institutions that bridge the gap between savers and borrowers, manage those inherent risks, and keep the wheels of finance turning smoothly.
He emphasizes their importance not just for facilitating economic activity, but for shaping the very structure of the financial system.
Banks, insurance companies, mutual funds, they're not just passive conduits for funds. They actively assess risk, evaluate borrowers, and allocate capital, which influences the direction and stability of the entire financial landscape.
So their decisions have a ripple effect throughout the economy.
Think about a bank deciding whether to approve a loan. They're not just looking at the borrower's creditworthiness, they're also making judgments about the overall economic environment.
Are they optimistic about future growth? Are they worried about inflation? Do they see heightened risks in certain industries? These decisions influence lending patterns and ultimately impact investment, job creation, and overall economic health.
It's this constant interplay between individual choices and systemic outcomes, this balancing act between risk and reward, prudence and innovation.
Mishkin's analysis gives us this valuable framework for understanding this complex ecosystem. It illuminates the forces driving financial markets, the institutions that shape them, and the policies aimed at ensuring stability and promoting growth.
It's an ongoing journey of discovery, revealing how interconnected the financial realm is and the role we all play in it.
Now, as we move into the final part of this deep dive, let's turn our attention to perhaps the most enigmatic entity in the financial system, the central bank.
The institution shrouded in mystery, the one controlling the money supply, setting interest rates, and acting as a lender of last resort during those turbulent financial storms.
Mishkin dedicates a significant portion of his work to demystifying the role of central banks, focusing primarily on the Federal Reserve System here in the U.S.
It's a powerful institution tasked with maintaining price stability, promoting full employment, and safeguarding the stability of the entire financial system.
And it has some pretty powerful tools at its disposal.
Open market operations, reserve requirements, the discount rate, these are just a few of the levers the Fed can pull to influence the flow of money and credit throughout the economy.
Mishkin doesn't just describe these tools in abstract terms. He gives concrete examples of how the Fed has used them to navigate economic booms and busts, combat inflation, and prevent financial panics.
He digs into their strategies, the debates surrounding their actions, their successes, their missteps, all of which have shaped the Fed's evolution and its impact on the American economy.
It's a fascinating look at the interplay between monetary policy and economic outcomes. It reminds us that even the most powerful institutions are operating within a complex and often unpredictable system.
Mission also delves into the criticisms and controversies that inevitably surround the Fed's actions. He explores the arguments for and against central bank independence, the potential for political influence, and the challenges they face in a constantly changing global financial landscape.
It's a nuanced and thought-provoking discussion that highlights the ongoing debate about the appropriate level of government intervention in the financial system, this balance between stability and innovation.
Mishkin's analysis prompts us to critically evaluate the powers and limitations of central banks, their impact on our lives, and the challenges they face in an increasingly interconnected and volatile world.
So, as we embark on this final chapter, let's unravel the intricacies of central banking, exploring its tools, strategies, triumphs, failures, and its enduring influence on the global financial system. Okay, so let's unravel this mystery surrounding central banking. Mishkin takes us back to the creation of the Federal Reserve in the early 1900s, a time when there was a strong aversion to centralized financial authority in the U.S.
It's an interesting contradiction. The Fed was actually created as a direct response to a string of devastating financial panics that had rocked the nation.
So it was born out of necessity. They realized they needed a lender of last resort to step in and stabilize the system during crises.
Exactly. But the Fed's structure reflects that ingrained distrust of concentrated power. They opted for this decentralized model with 12 regional Federal Reserve banks spread out across the country.
Each with its own president and a degree of autonomy, quite different from those centralized, all-powerful central banks we see in some other countries.
Right. And Miskin notes that while this decentralized structure was initially popular, over time, the Federal Reserve Board of Governors in Washington, D.C. has gained more control, essentially centralizing monetary policy decisions.
And the chair of the Board of Governors has become this incredibly influential figure with the power to sway interest rates, financial markets, and the entire economy.
Think about figures like Alan Greenspan, Ben Bernanke, or Janet Yellen. Their words could move markets and impact millions of people.
Okay, enough history. Let's get practical. How does the Fed actually manage the money supply?
It all comes down to controlling the monetary base, the reserves held by banks, and the currency circulating in the economy.
And they primarily do this through open market operations, right?
Yeah. Right. By buying or selling government securities, mainly treasury bonds, the Fed can adjust the money supply. When they buy bonds, they inject reserves into the system, expanding the monetary base and making more credit available.
And selling bonds does the reverse, pulling reserves out and tightening credit.
Miskin explains how these open market operations affect interest rates, bank lending, and ultimately the overall level of economic activity.
And of course, there are those other tools in the Fed's arsenal,
Right.
reserve requirements, the discount rate, and those more unorthodox measures they've deployed in recent times.
Like quantitative easing and forward guidance, these strategies have become commonplace, showing how the Fed has adapted to this increasingly complex global economy.
Now, shifting focus a bit, what guides the Fed's monetary policy decisions? They're not just reacting to the latest economic data, are they?
No, it involves setting targets and benchmarks to guide the economy towards its main objectives: price stability and full employment.
We hear a lot about inflation targeting, where central banks try to keep those price increases under control. Does Mishkin talk about any other possible targets?
He explores some alternatives, like targeting nominal GDP growth or even focusing on asset price bubbles to prevent them from destabilizing the financial system.
Sounds like a complex and constantly evolving debate.
It is. Economists and policymakers are always weighing the pros and cons of different approaches, dealing with those inherent delays and uncertainties that make monetary policy so tricky.
Mishkin also delves into those pivotal moments in history where the Fed faced its biggest challenges.
The Great Depression, the stagflation of the 1970s, the 2008 financial crisis. These events really put the Fed to the test, exposing both its strengths and weaknesses.
And his analysis provides valuable insights into the lessons learned from those episodes, how monetary policy thinking has evolved, and the ongoing search for that magic formula to achieve lasting economic stability.
He also broadens the perspective by looking at monetary policies in other countries, comparing their approaches and highlighting those common challenges faced by central banks worldwide.
Underscoring the reality that the financial system is now truly global. Decisions made in one country can impact the entire world.
Which brings us to the International Monetary Fund, that global lender of last resort trying to stabilize currencies, prevent financial contagion, and encourage economic cooperation among nations.
An institution that often finds itself at the heart of controversy, but nonetheless plays a vital role in this turbulent global financial system.
It does indeed.
As we wrap up this deep dive, I'm amazed by the scope of Mishkin's work. He's given us a comprehensive framework for understanding not just how financial markets work, but the institutions that shape them, the policies that govern them, and the historical forces that have driven their evolution.
It's been an enlightening journey from those early forms of money to the complexities of derivatives, from the structure of banking systems to the critical role central banks play in our globalized world.
We've explored the dangers of asymmetric information, the ever-present risk of financial crises, and that delicate balancing act between stability and innovation.
Mishkin's work encourages us to think critically, question assumptions, look beyond the headlines, and engage in thoughtful discussions about the forces shaping our financial destinies.
It emphasizes that financial literacy isn't just about managing our own money, it's about understanding the system as a whole.
Exactly.
It's about recognizing those levers of power, those potential pitfalls, and those opportunities to create a more stable and equitable financial future for all.
And with that in mind, let's distill our key takeaways into 10 essential points to help you navigate this dynamic landscape.
A financial toolkit of sorts.
Precisely. First, interest rates. They reflect the cost of borrowing and have a widespread impact on the economy.
Second, the financial system. It connects those with surplus funds to those seeking capital, facilitating the flow of resources.
Third, financial intermediaries.
Yeah.
Banks, insurance companies, mutual funds, they play a crucial role in reducing risk and addressing information asymmetries.
Fourth, asymmetric information. It leads to adverse selection and moral hazard, prompting financial institutions to develop strategies to mitigate these risks.
Fifth, financial crises. These disruptions occur when the flow of funds is interrupted, often due to spikes in adverse selection and moral hazard.
Sixth, government regulation. It's essential to ensure fairness, stability, and to minimize those systemic risks in financial markets.
Seventh, the U.S. banking system. It has a distinct structure and competitive landscape, shaped by historical regulations and ongoing deregulation.
Eighth, financial innovation. It offers both opportunities and risks, requiring a balance between promoting progress and mitigating potential downsides.
Ninth, globalization of finance. Events in one nation can have a ripple effect across the globe, emphasizing the need for international cooperation.
And 10th, central banks. They have powerful tools to manage the money supply, influence interest rates, and maintain financial stability, but their actions are often debated and scrutinized.
This list is a solid foundation for understanding the complexities of finance. But remember, learning never stops. The financial world is constantly changing.
Thank you for joining us on this deep dive into the world of finance. Until next time, may your financial decisions be well informed, your investments wise, and your understanding of this fascinating world ever growing.